and welcome to The Sound of Economics, the podcast from Bruegel, the Brussels-based economic think tank. I'm your host, Rebecca Christie, and I am here today with our director, Jurman Zettelmeier, and Peter Pratt, well known to all of you who follow the macroeconomy from his work at the ECB and elsewhere on the scene. And we are going to talk about what is going on with the world today. In the terms of The Sound of Economics, of course. We are seeing a situation where the U.S. is projected to grow much faster than other advanced economies, but the U.S. also is this huge source of uncertainty and possible risk. What's going on right now, and how should we think about it?
Well, as you know, in Europe, we had a succession of severe supply shock, basically, which the US was hit much lesser than Europe. And so that explains fundamentally a difference between the US and Europe. What is striking today is that the savings ratio, especially for households in Europe, remains quite high. And this is a big surprise. The ECB was predicting a recovery of consumption and investment, and basically we don't see that. In the US, you have a totally different situation. Not only you have very strong animal spirits today, but you also have a very expansionary fiscal policies and also all these promises of deregulation in the US, which supports, investment intentions and all that. So the situation in Europe is very worrisome because we were waiting for a recovery, and all the uncertainties that you have mentioned are really coming at a time where we saw a timid recovery.
Jurman, does Europe need more animal spirits?
Yes, but you earn your animal spirits by doing serious reform, serious investment, tackling your structural weaknesses. A lot of this is the stuff of the Draghi report. The Commission is by and large embracing this. It published a by and large coherent document that takes up most of Draghi's themes about a couple of weeks ago, the Competitiveness Compass. It will put out more documents of this type. And they, basically show that they're trying to do the right thing with, one important exception. There is not much money at the EU level, and so they're trying to be creative in tapping member state funds to make up for that, and that can only go so far. But basically, the best that we can do to mobilize our own animal spirits and deal with the problems we're getting from the US is to fix ourselves, and I think that recognition is broadly there. What is not clear yet is whether we are brave enough to overcome the deep reasons why we haven't done some of these reforms in the past. And of course, the hope is that, being with the back against the wall, we're going to get there.
A weaker euro helped Europe recover from the euro sovereign debt crisis. Is that something we can see again, or are things different now?
So we have a very slow economy in the euro area, and so I do think that the right macro approach is to, if anything, accelerate or maintain the speed of easing on the monetary side. A weaker euro is a reflection of that. It is also a reflection of the asymmetry so far in tariffs or tariff announcements between the US and Europe, which is something that may go away. Right, so to the extent that there is a general tariff war, and also depending on things that happen in the U.S., whether the totality of U.S. policies hurt the U.S. more than Europe, it may reverse. For now, I think that a weaker Europe does help, but it is not completely unambiguous because we are also an import-dependent continent. We rely on intermediate imports and energy inputs that are cheaper to produce elsewhere. So it's not a panacea.
What do you think, Peter?
Yeah, well, I think it plays a minor role. I think the exchange rate has remained quite stable, actually. There have been some movement, but I think it's a marginal element in the environment we have seen. Actually, the succession of shocks that we had, we were just coming out of that. And now we have this geopolitical shock with a lot of trade uncertainties. And I think really the big worry today is that the recovery, the increase of consumption the increase of investment is probably will be difficult to see. Jérôme, you mentioned, of course, the all the list of what to do. I mean, we know that pretty well. And I think the assessment has done, which has been made by the Commission now, I mean, following the Draghi report, is pretty clear. But if you want to implement all that, it's going to take a lot of political will, and it's going to be very difficult. If you see the political situation in countries like France, like Germany, it's going to take a lot of time. And in between, you have all the trade uncertainties that are going to hit Europe very much. So even if the tariffs are more moderate, that what has been, signaled by the American president, the trade uncertainty is really a big issue, and we have to think carefully about the impact on supply chains in general. They are going to be more expensive. There will be a lot of, uncertainties about investment decisions, and that's not very conducive to a recovery. And I think that's a huge issue. The other thing is the situation of public finance. We haven't discussed that yet, but the situation of public finance is absolutely awful in a number of countries. Not in all countries, fortunately, but in a number of countries like France, Belgium, and Spain also, and Italy. And so we know that there is a big pressure to increase defense spending by a few percentage points of GDP in the coming years. I don't see where this is going to be found. So it's going to be quite difficult to mobilize the resources which are needed for defense, and diverting maybe some of the very weak domestic demand, for defense. And so the situation looks quite gloomy today in Europe, and that's what they're talking about. But implementing, the number of reforms which have been highlighted in the Draghi report is going to be very difficult.
So I think that, this is all well taken, and I agree that without a lot of pushback from EU policy, the stuff that is in the pipeline is contractionary, right? For the EU, that is, particularly what's coming out of the US, but also the cycle that we are in, and that the ECB can attenuate this, but it cannot produce a fast recovery. So, the normal textbook approach would be fiscal expansion. And here, even though many countries have limited fiscal space, and of course the new fiscal rules put restrictions even on countries that would have some fiscal space, the EU as a whole does not have a sustainability problem. So it's still true that at the EU level, we could afford a fiscal expansion. And what is even more true is that this could be justified entirely through the desirability of raising investment, which is well documented. So our public investment needs are enormous. And so, the question is, might we be at a juncture where this becomes politically feasible? From what I pick up so far is no, except possibly in the defense area, which, if it were financed through borrowing and well spent, would be expansionary. So there's some evidence of that, certainly in the short run, and possibly even in the longer run, because of productivity growth and innovation that goes along with it. But I think that in itself is not going to be enough to really turn around the cycle. But having said that, the combination, I think, of relatively serious regulatory reform, which is something that is certainly supported by member states and by the Commission, and some stimulus through the defense side, some single market reforms, that would be a good start.
No, I agree. I agree with you. It's not going to be easy. One of the positive factors, which I said is negative, which is the savings ratio is very high. Well, if you could turn that around, of course, that would become positive. But for that, you have to mobilize savings. As you say, I mean, you need to send governments need to send very strong signals. They have themselves probably to spend more and wisely, which is not obvious. And second, as you say, there are structural reforms which are in the pipeline, but it's going to take some time. Now, when you look at, to give a more positive tone, when you look at stock prices in general, not only in the US, in the world, but also in Europe, you can see that a number of enterprises, of corporations, big corporations, are doing pretty well today in this gloomy environment, not necessarily because of the domestic market, but also a number of firms in Europe are in relatively good position on international markets and also on domestic markets. So there are not only bad things, about Europe. There are a number of firms which are quite competitive internationally. The other thing is that yes, there will be a lot of spending in defense. Can that be spent relatively wisely? Wisely is very difficult to judge, but also in a way which would mean that there are spillovers on domestic demand. So there's not only buying weapons in the US, but also supporting technological development related to defense, I admit, but technological spending related to defense. There are also ways there. I think Europe, it's almost sure for me, that's going to overborrow in the coming years. Overborrow, I mean, above what is foreseen in the Stability and Growth Pact. I think that's unavoidable. And probably the question will then be, what will be monetary policy in that sort of environment? So that will be an important question in the coming months. But the main issue in Europe is to try to build trust, to stimulate animal spirit, and that's not going to be easy, frankly.
It's not easy because the concern of policymakers is that there's still sort of a sense, at least in finance ministries, that you want to keep some of your powder dry, right? So there's still a concern that, it might be bad, but it could get a lot worse. And so to go all out now and reduce your fiscal buffers just at a time when we had all agreed to increase our fiscal buffers and come down from very high levels of debt after the pandemic and the energy shock is tough, right?
Yes.
So there's a sense that we want to be conservative for a while before we start spending again. But we may not have the luxury of rebuilding these fiscal buffers for very long, and so the way to reconcile, I think, the need to do more through fiscal instruments with avoiding risks is to target areas of spending that reduce those risks or raise efficiency, right? Which is essentially the Draghi message, right? So do it in a way that greases or enables or facilitates EU-level efficiency gains. And so here the big items I think are on energy infrastructure, which could reduce energy costs and then would have a supply side effect that might help with those animal spirits. And then the other reason, of course, is defense. I mean, the most catastrophic thing that would require dry fiscal buffers is a future war, which we know historically leads to extremely large increases in public debt that might indeed take us over sustainability limits. The best we can do now is to deter such a war, and that requires really investing in rearmament, I think.
No, I fully agree. It's going. I don't see governments, cutting in welfare in a number of spending today. So the pressure you have on defense spending, which is sizable, I mean, is going to dominate the political debate, and so we're going to have escape clauses for defense, and that means that fiscal deficits, on an aggregate basis, are going to be higher. I hope reasonably higher. There will be some reforms, hopefully, that will support supply side. That may take some time, but that would send, good signals about debt sustainability. So in the short term, you may have, again, an increase of fiscal deficits, talking about especially 26, 27. And if that could be, paired with structural reforms, that could be digested, in a reasonable way by markets in general. But there is a general concern in markets about fiscal policies everywhere, especially in the US, but also in a number of European countries. So at some point of time, we're going to see the risk premia on long-term rates, continue to increase. They have already increased, especially in the US. But I think what we have seen there is only the beginning. So fiscal policy, yes, I think it's unavoidable to increase spending. Unfortunately, I would say, will be politically very difficult to cut, on welfare and other sort of spending. Look at the political situation in a number of countries, so that would be absolutely difficult. The hope is that structural reforms, which will take more time, will be decided, and that would, keep confidence of markets in general. I can say that within the ECB, fiscal policy is one of the main concerns for policymakers.
Peter, where does the ECB balance sheet fit into all of this? ECB, through its quantitative easing policies, amassed large numbers of EU sovereign bonds, and there's been some debate about what to do with them as the monetary policy environment has shifted. How will that affect these fiscal needs?
I wouldn't say it affects. I mean, the ECB has reduced actually its balance sheet much more than other central banks, basically via the reimbursement of banks, of the special credit facilities that have been provided by the ECB. So the balance sheet is going down of the ECB, but the question is, in that sort of environment of potentially much higher fiscal spending, can you have on long-term rates? Can you have at some point, market disruptions, maybe in some countries or globally, and then you will have to see, what the central banks are doing. I mean, and for the time being, what you basically see is that central banks basically have lowered their interest rates, with a pause in the US for the time being. Long-term rates have gone up, especially in the US, but to some extent also in Europe. So, on one side, monetary policy tries to ease policy, but the long end of the market goes the other way. And that's related basically to fiscal policies and to some uncertainties related to inflation in the future. So the balance sheet of the ECB, I think, for the time being, is considered as a tool that you are not going to use to support the economy. But with one big caveat is that there is a big agreement that if there are disruptions in the functioning of bond markets, the balance sheet will be used quickly and heavily, actually. And there is agreement on this, as you have seen in the US in some episode, that you have seen in UK. I think there is this willingness of central bank not to allow market disruptions to take over. And in that sort of environment that we see today, these sort of risks should not be neglected. So the central bank balance sheet basically is considered as a tool that you could use in extreme circumstances temporarily in case of market disruptions, but not as an instrument for the time being of supporting the stance. I know that when you contract the balance sheet by QT, by not reinvesting in bonds, that creates some tensions on the long end of the market, on the bond market, but I think it's relatively marginal for the time being. So it's a relatively orderly reduction of the balance sheet that you see now, also in the United States, by the way. So the main reason why long-term rates go up is not because of QT. I think it's basically because of concerns about fiscal policy and also some concerns about inflation.
Thanks for that. I find it very helpful to untangle some of the technical effects of all this activity in the markets from the fundamentals of who's growing and why.
Maybe just to add, of course, another reason why you would not expect the balance sheet to be used except in a bond market emergency right now is because interest policy can do the trick, right? We are still away from the effect of lower bound and interest rates. There's still scope to ease, and that will remain the case as long as we are not in a depressed situation where we return to a low interest regime. And whether or not we will get there has a lot to do with those animal spirits, private investment, but also with with fiscal policy. And so on fiscal policy, I do believe there is a fiscal policy that can square the circle, if you like. And the essential ingredients of that fiscal policy are one that is expansionary, but where at the same time there is underlying adjustment in the non-investment, non-defense budget in the direction of reducing welfare spending and possibly also increasing taxes. So, the net impact of those factors would still be expansionary. So we should see an increase in deficits or indeed in bond issuance at the EU level.
I agree, Jeroen. You're absolutely right. I think I fully agree with what you say. But is it likely to happen? This is a question, given the political constellation that you see.
Let me make a pitch for why I wouldn't get overboard and say it's likely, but why it is not entirely implausible. So the pitch is what do we need for this to sell politically? We need a sense of emergency, right? We need a sense of belt tightening that is essentially justified with mostly defense and with maintaining critical public investment that is going to be very important for competitiveness, particularly in the energy sector. I think that can be sold, and so you can require some belt tightening in the form of lower social spending, in the form of possibly higher taxes, some sort of surcharge financing defense. But the important thing is that the net impact of these, the fiscal impulse is still positive. It has to still be expansionary. And, the reason why this is consistent with sustainability is because there is the well-founded hope that the investment that is being financed by this and the build-up in defense capabilities that are being financed by this are temporary, right? So they are there to respond to make a level adjustment, a stock adjustment, right? We need to raise stocks of arms. We need to complete some investments, grids, renewable energy resources, interconnectors that once they're built will last for a long time. Whereas in principle, the changes in the non-investment budget that you're making at the same time are of a permanent structural nature, right? And so this is the famous trick of how you can reconcile expansion with sustainability. You put measures in place at the same time when you are expanding the budget that guarantee repayment in some sense once the crisis is done.
I want to bring it back to the European consumer for a minute. Peter, you talked about the high savings rate. It seems like in past crises, we've looked to European households to bring more domestic demand, and now we're looking to them for more domestic investment. We're talking about European Savings and Investment Union on top of the efforts to unify capital markets. We're talking about better pensions and getting money off the sidelines. At the same time that almost everybody in macro land says, yes, we have to do this, there's tremendous skepticism in the member states for messing with the pensions, for encouraging households to take on what is perceived as more risk. Do either of you have any ideas for how to convince the European that this is a good time to get excited? I mean, I've written about the possibility of a new savings product that is marketed and put forward publicly as a way to increase financial literacy and give people the confidence to do this. But beyond that, aren't we sort of depending on confidence among everyday people that just isn't there?
Well, the different points that you're making, I think the depressing thing in Europe, of course, is that the savings ratio is quite high. Private saving is quite high. And this sort of high savings rate basically finances is flowing to the United States. And if some part of that savings goes into equity, goes into US equities and not so much European equities. So if you want to change that, you need two things. I mean, first, is how can you stimulate domestic demand? Here, gave a little bit the roadmap. You need to bring strong signals of structural reforms, that would, encourage investment and mobilize then private savings. So that's the first things to do. Increase domestic demand. And the second thing, of course, is to try to channel, this domestic savings into, equity, more equity risk-taking, sort of investment. And for that, you need also to address the issue of pension funds and all that. I mean, if you see, I think there are good examples. If you look Sweden or you look the Netherlands, if you look at the savings ratios in these countries are high. They basically go in pension funds. And in the pension funds, basically, they are allocated the big allocation in equity.
Well, a lot of those equities are going to the U.S. The issue isn't that it's the U.S. The issue is that too much of the money is in cash, which is a different question.
Absolutely. So, but it's absolute. I think these are very good examples, the Netherlands or Sweden, because there is a big share of savings which goes in equity, but goes in US equity. So what you need to do at the European level is two things. I mean, first is increasing domestic demand, reducing savings, and have the allocation of savings into European equities. But for that, you need structural reforms. You need strong signals, that will channel that money to European firms and not US firms. And that's why, the Draghi agenda, I mean, these sort of things are quite important, of course.
But what is the role in all this of US performance, right? So there's clearly so far a sense that, European growth and the European equity markets and US growth, US equity markets are somewhat substitutive, right? I mean, in the most recent forecast revisions of the IMF, you can see that. So it's almost a symmetric movement of the US being upgraded by half a point on growth and Germany being downgraded by half a point. Now, we should not take this as being causal, right? But if the issue really is that European savings get sucked into the US and that hurts our market, there is a quite significant chance that that problem may take care of itself by the US essentially crashing, as it becomes increasingly clear to equity markets that these Trumpian policies are really not good for the US itself.
So there's two things there that I would like to come back to. One of them is just the European conundrum of did the savings go out of the economy? Are they spent? Do they sit in bank accounts, which is where about half of them are right now? Or do they go into equities of any sort? I would argue that as long as they're going into equities and making money, even if they're making the money in the U.S., that can be good for Europe because it generates returns that can go into Europe. There's also the question, of course, can we get that stuff into the EU? But as we move into the second half of our podcast, I'd like to talk about those risks that you just brought up, Jeramin, about a U.S. asset bubble, about U.S. disruption. Because it's not just that the U.S. is growing, it's that the U.S. is doing a lot of really unpredictable things that could cause a crash. And how do we think about that?
Yeah, please, Peter, go ahead.
I agree. I think when you look at markets today, markets are quite positive, quite optimistic about what is happening in the US, also what is happening with Russia, and so there is a lot of euphoria in markets. I agree with Jérôme, who alluded to that just before. I think what we see in the US is unsustainable. From the fiscal side, I think it's unsustainable. All what we see, the uncertainties about the rule of law, and not only internationally, but also domestically, at some point of time, you will have consequences on confidence in general. So it may take a little bit time. Personally, I think that you're going to see inflationary pressures in the US. For me, I mean, that's very high probability that the Fed, today is pausing, but at some point, markets will start to talk about the possibility of higher rates. And then markets may react very strongly, and et cetera, et cetera. I think what we see today is a huge increase of uncertainty in general about the rules of the game in general, and I think I see it basically as a sort of steepening of the aggregate supply curve at the world level. I think supply is going to get lesser elastic. Because the supply chains are much more complicated to manage than they used to be. So the supply curve is much more inelastic, I fear, and also much more volatile because there will be, sort of frequency of shocks probably is going to increase, which creates a lot of dilemma for central banks in general, especially for the ECB, because, as you know, a world of supply shocks is not the best environment for central banking.
Yeah, I agree with that, and I think the point is that it is the U.S. where we would see the biggest correction, right? Because the assumption has so far been that the potentially counterproductive elements of Trump's economic agenda would be finessed, opposed by the parts of the administration that are closer to the economy and the financial sector, and what would remain is deregulation and low taxes, plus maybe a reasonable attempt to cut spending and reduce the deficit. And each of these assumptions is collapsing before our eyes. On the fiscal, what surprised me is that in a sense the determination of the administration to do something about the spending side was bigger than I thought. But at the same time, the haphazard, chaotic, and counterproductive nature with how they did it was also far beyond expectations. If you send an IMF mission to reduce the U.S. deficit, they would not do it in this way, right? They would work on the big spending items, the entitlement spending. They would not go around, terrorizing civil servants, slashing agencies that are a very small part of the total spending. So this is a textbook case of how not to do fiscal adjustment.
Yeah. I fully agree. And I think markets are increasingly worried about the fiscal situation in the US in the context you described. And the other thing is of course, the protectionism. So I think also from the US base, the electorate, at some point of time, people, common people will see the consequences of these policies. So for the time being, there's a lot of announcement effects. But they will have at some point concrete impact, on people, and negative impact. I'm convinced of that. So inflation, for example, the protectionist, measures that are announced, we will have to see, to what extent they are implemented. But I don't think the positive reaction, to deregulation, signals and all that, for the time being, that dominates, Wall Street. But the other aspects, which is a much more uncertain international environment and also domestic environment in the US, combined with a fiscal unsustainable position that you have there, I think this is heading towards, an accident. So it may take a year. I agree, it may take some time, but we're going to see some of the elements this year.
But Peter, just to be clear, do you think that such an accident, which normally we would think of being bad for everyone, right? Bad for the world economy, bad for Europe, that there is a silver lining for Europe in such an accident, because it's perceived as the one region of the world where that is still sustainable, where there's still the rule of law, where equity prices are not excessive, or is this just going to be bad for everyone?
No, I think you're right. That's the card that Europeans should play. Of course, say you are predictable in your policy. Maybe you are a bit too slow in reforms, and then investing in technology and all that. So that's where priorities have to be. But in a way, when you look big country, China, for example, they are I'm sure they're watching at the US as a sort of unpredictable sort of country, a major country, unpredictable, while Europe is much more predictable also in trade. So I think a number of people today say that there are no friends today, but the enemies of the US, basically China. Europe should look at China in a much more benevolent way than what we did before. And so the world is changing dramatically, And Europe, at some point, you're right. I mean, at some point, stability in Europe, sort of stability, the rule of law, and also, a relatively reasonable fiscal policy in general. I mean, will be assets in Europe, but we are not yet there. I think it's going to be worse before it's getting better.
Working with China brings up all kinds of questions of economic security, of foreign policy. We have many, many papers on our Bruegel website that listeners, you can go check out if you want to dig into those. I do want to come back to this idea, though, that historically, if the U.S. sneezes, the rest of the world catches a cold. German, are you convinced that it could be different this time because of all this uncertainty and because Europe at least has a core stability, even if it hasn't quite figured out how to get its engine running?
So I do not think it will be different to the extent that what is bad for the US is good for the rest of the world. So I don't believe that for a minute, because the US is just too central part of the financial system and, of course, our biggest trading partner as well. What I do think could be different is that in the past, when the US has sneezed, the rest of the world has gotten a cold that was worse than the cold in the US. So the US has benefited from a safe haven effect even for crises that were produced in the US, most memorably in the case of the global financial crisis, which was initially a crisis of the US subprime mortgage market. And yet, there was a generalized flight to quality that benefited the U.S., and the U.S. was less affected than most parts of the world, of course, particularly in Europe, emerging Europe. That, I think, could be different, right? Because the reason why this was true last time is because, for two reasons. Fundamentally, there was great faith, and appropriately so, in U.S. institutions. And second, there was great faith in U.S. treasuries as the global safe asset. But now, that's where the crisis could originate. Rather than originating in the U.S. subprime, it could, originate in the primest of all assets, the U.S. Treasury market. And so I think that the next crisis might be different in the sense that the U.S. does not benefit from a safe haven effect. And the question is, what would be the safe haven? I don't know, maybe gold, or maybe it might be, European assets. And whether that's the case or not, that will depend on our, relative situation. Do we go in the right directions on the Draghi agenda and reforms? Are we about to be attacked by Russia? So there are many reasons not to consider Europe as a safe asset, but at least the question will be asked.
We are almost to the end of our time. Peter, do you have any closing thoughts or a closing prediction?
I think it's going to be difficult. The coming months, the coming 6 months are going to be very difficult. I'm thinking about Ukraine, Russia, and the big shift, in U.S. policy vis-à-vis Russia. What we have seen the last few days have been really shocking. It remains for me to be seen to what extent that affects business spirit in general. So far, we haven't seen that very much, but this is a huge change, and that will put big pressure on public finances. You see a number of countries, if you look at Spain, Belgium, and even Germany and all that, we talk about a few percentage points of GDP of increase in defense spending and mobilizing, resources to defense. That's going to be extremely, extremely difficult politically to manage and economically to manage, but politically also to manage. And so I think the next 6 months are going to be extremely difficult. In that sort of environment, are we going to see a recovery of domestic demand? So the ECB may cut the rates by another 1 percentage point from where they are now, but it's not going to make a big difference, in what we are discussing, because all the elements, dampening demand are not related to interest rates in general, certainly not monetary policy interest rates. So it's going to be difficult. So we should not hide ourselves behind.
You've been listening to The Sound of Economics. I'm Rebecca Christie, your host. I've been joined today by Jeroen Zettelmeijer and Peter Praet. You can see all of Bruegel's reports and thoughts and recommendations on these issues on our website, bruegel.org. You can find other episodes of this podcast on all your favorite podcast channels. Thank you for joining us, and we'll see you next time.
Free audio post-production by alphonic.com.